Welcome to The Good Capital. Before we begin, please note that our content is for educational purposes and is to help investors to stay informed.
Today, we are going to look at the real insights behind 5 massive SaaS companies. We aren't just looking at revenue growth or hype, we are analyzing their economic moats, the structural fortresses that dictate whether a company is going to run a durable business. We evaluate a company's structural durability by its ability to sustain economic profits. What does that mean? It means a company must generate a return on invested capital, ROIC, that consistently exceeds its weighted average cost of capital, WACC, over a full business cycle. That spread, ROIC minus WACC, is the fundamental engine of long-term durable business. We are going to assess 5 major SaaS players, breaking down their moats, their financial realities, and their key risks. First up is AppLovin. This company operates a leading ad tech platform, but don't let the mobile games they own fool you. Their true economic engine is AOXN predictive AI technology, which connects advertisers with highly targeted users. Detailed mode analysis. Network effects 9 of 10. AppLovin benefits from a profound two-sided data network effect. As more publishers use their Max platform to monetize ad inventory, more advertisers flock to app discovery. This density feeds billions of data points into the AOXN AI engine, improving targeting accuracy, which drives higher return on ad spend, ROAS, ultimately attracting even more ad budgets. Switching costs, 7 of 10. Integrating AppLovin's SDKs, such as Max Mediation, into a mobile game's core code creates notable technical friction. Ripping it out risks immediate monetization downtime and yield degradation for developers. Cost advantages, 6 of 10. The software platform demonstrates immense operating leverage. The fixed costs of algorithmic R&D and data center infrastructure are spread over a rapidly scaling revenue base, allowing for outsized marginal profitability. Intangible assets, 8 of 10. The proprietary AOXN 2.0 predictive AI model is a highly specialized closed-loop algorithm. Competitors find this exceptionally difficult to replicate without access to AppLovin's specific scale of historical performance data. Efficient scale, 5 of 10. The ad tech mediation layer has consolidated into a functional oligopoly consisting of AppLovin, Unity, IronSource, and Google, effectively discouraging new entrants from attempting to build a subscale mediation network. 2. AppLovin's pricing power is strong. The company operates on a performance-based model, essentially taking a toll on the transaction volume flowing through its platform. Because its AI engine consistently delivers superior user acquisition ROAS compared to peers, developers willingly tolerate AppLovin's take rates. Software platform EBITDA margins have sustained above 70%, proving the company commands significant pricing power due to unmatched algorithmic efficacy, rather than competing on race-to-the-bottom pricing. This means inflation doesn't crush their margins. They pass the cost on to the ecosystem. 3. Financial reality. AppLovin has recently demonstrated a dramatic inflection in capital efficiency. Driven by the rollout of its Axon 2.0 AI engine, the software platform segment's explosive growth has pushed the company's ROIC well beyond 25%, eclipsing its WACC of approximately 10%. This spread confirms that AppLovin is not merely growing, but generating economic profits and massive free cash flow conversion. 4. Risk assessment. Consider the systemic threats from platform gatekeepers like Apple and Google. Any further deprecation of tracking identifiers, such as Google's privacy sandbox initiatives, could disrupt signal liquidity and blind the Axon engine. Furthermore, heavy reliance on the mobile gaming sector creates cyclical vulnerability to consumer discretionary spending. 5. Verdict. Narrow moat positive trend. AppLovin is rapidly building a wide moat on the back of its AI-driven network effects. If its expansion into non-gaming verticals like e-commerce and connected TV succeeds with the same unit economics, it will definitively achieve wide moat status. Ad tech is lucrative, but it's dependent on consumer spending. Now let's look at a sector that companies must buy, even in a recession: cybersecurity. Palo Alto Networks is the world's largest independent security vendor. Detailed mode analysis. Network effects, 8 out of 10. The company leverages a powerful crowdsourced threat intelligence network. When a zero-day vulnerability is detected at one customer node, Palo Alto's AI updates the defensive posture for over 80,000 enterprise customers globally in near real time. Switching costs, 9 out of 10. Cybersecurity architecture is the central nervous system of modern enterprise IT.
Removing core firewalls or endpoint agents involves massive execution risk, potential network downtime, and extreme vulnerability exposure. Security chiefs are highly incentivized to remain locked in to proven vendors. Cost advantages, 5 out of 10. While the company benefits from R&D scale, the cybersecurity industry requires relentless, capital-intensive investment to keep pace with state-sponsored adversaries, neutralizing absolute cost advantages. Intangible assets, 8 out of 10. The Palo Alto brand is synonymous with premium enterprise security. It acts as a safe choice for Chief Information Security Officers, CISOs, which lowers the friction of high-ticket sales. Efficient scale, 4 out of 10. The total addressable market is massive and highly fragmented, leaving plenty of room for multiple multi-billion-dollar players. 2. Palo Alto's pricing power is strong. Gross margins remain incredibly resilient in the mid-70% range. In recent management guidance, Palo Alto introduced free trial bundling to drive long-term platformization, temporarily sacrificing upfront billing optics for long-term lock-in. Once customers consolidate onto the platform, Palo Alto exhibits the power to routinely raise subscription prices on threat intelligence and cloud modules without experiencing churn, as security is a non-discretionary budget item. 3. Financial reality. Palo Alto Networks has successfully transitioned into a phase of disciplined GAAP profitability. Its ROIC has structurally improved to the mid-teens, comfortably exceeding its WACC of 8.5%. Management's strategic pivot toward platformization, consolidating fragmented security tools, is accelerating lifetime customer value and driving sustainable economic profit expansion. 4. Risk assessment. The cybersecurity landscape is hyper-competitive and subject to rapid technological obsolescence. Failure to secure emerging attack vectors, like AI-generated deepfakes or quantum decryption, could permanently impair its brand. Furthermore, aggressive bundling by Microsoft, specifically Defender and Sentinel, poses a constant threat to Palo Alto's pricing leverage. Verdict: wide moat. Due to immense switching costs and a globally scaled threat intelligence network effect, Palo Alto Networks operates with a highly durable competitive advantage, assuring excess returns for at least the next decade.
Next is Intuit, the global fintech platform behind TurboTax and QuickBooks. Detailed mode analysis. Network effects, 7 of 10. The QuickBooks ecosystem connects millions of SMBs with certified accountants and third-party app developers. Accountants specifically train on QuickBooks, implicitly forcing their SMB clients to adopt the platform, creating a self-reinforcing adoption loop. Switching costs, 9 of 10. The general ledger is the operational heartbeat of an SMB. Migrating historical financial data, payroll systems, inventory tracking, and tax compliance to a new provider is an agonizing, time-consuming process, fraught with regulatory risk. Cost advantages, 6 of 10. Intuit spreads its regulatory and tax code compliance R&D across a massive user base, achieving per-unit costs that smaller upstarts simply cannot match. Intangible assets, 9 of 10. The brand equity is legendary. TurboTax is essentially synonymous with consumer tax filing in the United States, allowing it to acquire customers organically through sheer mindshare. Efficient scale, 5 of 10. The U.S. tax code is so complex that building a compliant, error-free engine from scratch deters most venture-backed startups from entering the space.
2. Intuit's pricing power is absolutely dominant. Intuit commands software gross margins exceeding 80%. It possesses a near-monopolistic ability to execute annual price increases across its TurboTax and QuickBooks Desktop and online user bases. Because the absolute dollar cost of the software is low relative to the critical nature of tax and payroll compliance, customer demand is highly inelastic. 3. Intuit boasts one of the most remarkable historical ROIC profiles in the software sector, frequently sustaining adjusted returns on capital above 20% against a WACC of approximately 8%. Its QuickBooks and TurboTax core engines remain pristine compounding machines, generating exceptional free cash flow. 4. Risk assessment. The most severe threat to Intuit's moat is regulatory and political. The IRS has recently launched and expanded its Direct File program, a free, government-sponsored tax preparation alternative. If this program achieves mass adoption, it could permanently destroy the lower-tier volume of the TurboTax business. Additionally, AI agents could commoditize basic bookkeeping, threatening QuickBooks seat growth. 5. Verdict: wide moat. Despite regulatory headwinds, the switching costs within the B2B QuickBooks segment and the brand power of TurboTax secure a wide moat.
Intuit's structural advantages are deeply embedded into the fabric of American small business commerce.
ServiceNow provides the cloud-based, AI-driven platform that automates digital workflows for the world's largest companies. Dominating IT service management, ITSM, and IT operations management, ITOM, the platform has aggressively expanded into employee HR workflows, customer service management, and custom creator workflows. Detailed moat analysis. Network effects, 6 of 10. The Now platform features an expanding marketplace of third-party integrations and a dedicated developer community, adding incremental value. It operates more as an ecosystem than a pure exponential network. Switching costs, 10 of 10. ServiceNow is the definitive system of action for Fortune 500 companies, orchestrating cross-departmental workflows. Replacing ServiceNow means untangling years of custom-coded operational processes, retraining thousands of employees, and risking business paralysis. Customer retention rates routinely hover at a staggering 98 to 99%. Cost advantages, 6 of 10. Sales and marketing efficiencies are massive. Because the core platform is already installed for IT, upselling HR or customer service modules require much lower customer acquisition costs. Intangible assets, 7 of 10. ServiceNow has become the definitive industry standard for ITSM. When IT professionals migrate between large corporations, they expect to use ServiceNow.
2. ServiceNow wields dominant pricing power. ServiceNow's gross margins rest securely near 80%. The company has successfully introduced Gen AI-powered features, such as their Pro Plus tiers, at a 30% price premium, and enterprise customers are actively migrating upward to capture productivity gains. ServiceNow does not discount to win renewals. The platform's mission-critical nature enforces total pricing compliance from the customer base. 3. Financial reality. ServiceNow is the gold standard of SaaS financial metrics. Its expanding ROIC, reliably generating economic returns in the mid to high teens against a WACC of roughly 8.5%. The company pairs 20% plus top-line revenue growth with expanding operating margins and immense deferred revenue balances, resulting in structural, long-term economic profit creation. 4. Risk assessment. The primary risk is market saturation. Having deeply penetrated the global Fortune 2000 for core IT services, future growth relies heavily on displacing entrenched competitors in non-IT departments, for example, fighting Salesforce in customer service or Workday in HR. Macroeconomic tightening can also stretch out the sales cycles for massive multi-million-dollar transformation deals. 5. Verdict, wide moat. ServiceNow possesses arguably the strongest switching costs in modern software. Once embedded, it becomes an immovable operational utility. Finally, we arrive at CrowdStrike. This cloud-native leader specializes in endpoint protection through its lightweight Falcon agent. 1. Detailed moat analysis. Network effects, 9 of 10. The CrowdStrike threat graph evaluates trillions of weekly signals. Every time a novel attack vector attempts to breach a single device anywhere in the world, the threat graph learns, adapts, and instantly inoculates all other endpoints across the global customer base. Switching costs, 8 of 10. Deploying the Falcon agent across hundreds of thousands of corporate laptops, servers, and cloud workloads is a significant operational lift. Removing it to install an inferior legacy antivirus exposes the enterprise to immediate catastrophic risk and regulatory noncompliance. Cost advantages, 7 of 10. CrowdStrike's collect data once, reuse many times architecture gives it a structural cost advantage over legacy vendors who require clunky, resource-heavy on-premise hardware updates. Intangible assets, 8 of 10. CrowdStrike's elite incident response unit, Services, acts as a powerful brand asset. When a major corporation is hacked, they call CrowdStrike to fix it, which invariably leads to the breached company purchasing the Falcon software suite. 2. CrowdStrike demonstrates strong pricing power. Subscription gross margins are consistently hovering around 78%. CrowdStrike has successfully executed a land and expand strategy, driving net retention rates well above 115%. Customers continuously adopt additional platform modules like LogScale or identity protection at full price due to the unified agent architecture. This land and expand model means their existing customers naturally grow the company's revenue without CrowdStrike needing to spend extra marketing dollars. 3. Financial reality. CrowdStrike is in a phase of hyper-scaling profitability. Having reached critical mass, the immense operating leverage inherent in its single-agent architecture is driving rapid margin expansion. ROIC is sharply accelerating past its WACC of 9%, transitioning the firm into a highly cash-generating compounding asset with sustained economic profit durability. 4. Risk assessment. The global IT outage in July 2024, caused by a faulty Falcon sensor update, highlighted the immense systemic risk of kernel-level software access. While churn was remarkably contained, which actually proved the Moats' resilience, any future architectural failures will shatter trust. Furthermore, Microsoft's aggressive bundling of Defender into E5 enterprise licenses forces CrowdStrike to constantly prove superior efficacy to justify its premium standalone cost. 5. Verdict. Wide moat. Tested by a historic crisis, CrowdStrike's moat held firm. Its compounding data network effects and expanding module adoption secure its position as a generational wide moat cybersecurity platform. Understanding these 5 companies and separating true structural durability from fleeting momentum. If you want to protect your capital and build generational portfolio, you must look for high switching costs, deep network effects, and a mathematically sound spread between ROIC and WACC. If you found value in this breakdown, hit the like button, subscribe, and tell us in the comments below. Which of these 5 software fortresses are you adding to your watch list, and what other companies do you wish us to check out? See you in the next one.